There's ghost chains still alive with billions of dollars in assets doing nothing. Yeah. It's great. I mean, Ripple is amazing tech, but no idea what they do. They're the largest altcoin. Yeah, it's very hard to be a founder in crypto these days. Lack of a retail bit is very apparent. Meme coins are up more than most alts this week. AI coins are up more than most altcoins and infrastructure coins this week. It's a tough market. Yeah. And I sympathize with the founders.
Hi, everyone. Welcome to Unchained, your no-hype resource for all things crypto. I'm your host, Laura Shin. Every episode, we're featuring your comments. Here's what you had to say about Coinbase's recent acquisition of Deribit from my interview with Owen Lau. On X, MexDax said, looks like Coinbase just secured a sweeter deal than Donald Trump. Also on X, Astori Viola said, bruh, derivatives are the real playground, but $2.9 billion for Deribit Coinbase? What's the master plan here? Want to hear your comment on Unchained? Leave it on Farcaster, YouTube, or X. We read every one. This is the May 13th, 2025 episode of Unchained. Crypto moves fast. It's why Bitwise launched the weekly CIO Memo, a jargon-free summary of what's moving crypto markets, written by one of the best in the business, CIO Matt Hogan. Get up to speed in 5 minutes or less. Check it out at bitwiseinvestments.com/CIO Memo. Carefully consider the extreme risks associated with crypto before investing. Today's topic is market making in crypto. Here to discuss are José Macedo, founder at Delphi Labs, Omar Shakeeb, co-founder at SecondLane, and Taran Sabharwal, founder and CEO of STIX. Welcome, José, Omar, and Taran.
Hey there. Thanks for having us.
Thanks for having us, Laura. Great to meet you.
Thanks very much.
So the ostensible reason we're all here is because of the market making scandal involving Movement and two firms involved in that Web3 report and RunTech. And this is involving a report that CoinDesk published that showed that these entities appear to have written up a contract that seems to kind of like plan or at least incentivize a pump and dump on users. And Binance banned the market maker Web3 report after it made $38 million from market making. So that's how the story first began to unravel. But before we get into all those details about that particular case, let's actually just have Taran and Omar specifically describe your businesses. So Omar, do you want to go first?
Sure, definitely. In a short nutshell, been in the space since 2016, 2017, literally started in the trenches, ICOs, etc. Saw movement and OTC, VCs buying assets like Solana, Atom, Dots, you name it. That's where our business in SecondLane started, like one of the oldest OTCs in the space, probably. And we saw this movement on OTC happening, secondary markets, and we just expanded on it and made it bigger. And by now, it's regulated on our end through our broker-dealer from the US. So that helps us reach out to potential parties in the space who never have interacted on OTC side. So that's it on our end in a short nutshell.
Taran?
I run a company called STIX. We are a trading firm focused on secondaries and OTC transactions. Primarily, any sort of transactions you hear about that are private and not on exchanges go through basically Omar and I's desk. That's us in a small nutshell.
All right, so let's talk about market making. Let's just talk about it generally. Like, why do they exist? What problem are they trying to solve for token issuers or just like market participants generally? And anybody can go. So just say, since you haven't spoken, maybe you want to start.
I actually think maybe Omar and Taran have a good take on this, but the supposed purpose of a market maker is just to provide liquidity for a token on a bunch of different venues, right? To make sure there's enough liquidity for people to buy and sell, and they're supposed to make money on just sort of the bid-ask spread, right? In crypto, market making is slightly different, where they have these option agreements, which as far as my research, there's no real counterpart to this in TradFi. And these options agreements normally have basically, so they have a loan from the project of tokens, which they market make with. And oftentimes this is like a large percentage of the project's float. So of the tokens that are circulating, the larger the percentage, the more shenanigans they can do, obviously, because they sort of control more of the circulating tokens. And then they have this option with a strike price that sometimes it depends on the agreement. Sometimes it's the last round price. Some more sort of standard is that it's some kind of sort of premium to a TWAP post launch. So it might be a 7-day TWAP post launch, and the strike price is a 25 to 50% above that. So basically, if the price gets there, the market makers get to cash in on this option. And what that does is it does create a bit of an incentive to, to put it simply, pump and dump. But that's like sort of a very, I don't think like most of the reputable market makers in the space are doing this, but clearly some of the less reputable ones are. And it's a very non-standard sort of structure. But you can, and the fact that it exists in crypto, I think also probably highlights the power that market makers have, right? That projects basically believe that by incentivizing market makers with these options that are above, the price post launch, the market makers can somehow have an impact to getting the price there, right? That's sort of like the business logic behind this option, which in itself is a bit of an issue. And actually, I think what we recommend to most of our portfolio projects, especially the ones that have the leverage to do this, is to just hire a market maker on a basic retainer and ask them to just like make markets, guarantee a certain bid-ask spread, a certain uptime, the kind of things they do, because it's just a lot less messy than having these option agreements, which tend to backfire, which can backfire.
By that, what you mean is like it's a flat fee and there's no kind of like aspect where the amount that they would get paid is dependent on the token price going up. Is that?
Yeah, exactly. Yeah, exactly. So just pay them for the service, for the pure sort of commoditized market making service, rather than this. Yeah, rather than these like token performance based ones. And then I think there's like maybe more shenanigans that projects do with market makers that we can talk about later on. But I think that's the basic sort of like overview of what a market maker does and sort of how the deals work in crypto. But I'm curious, yeah, Omar and Taran, feel free to add anything to that.
I just want to jump in. I mean, pitfalls to avoid as a founder, there's two models. You can pay the market maker a monthly fixed sum, or you can go with the option model. Now, it's a matter of incentive, right? And what you want to achieve. Market makers do two things. They provide liquidity and depth. That's their main sort of business. And second is sort of like the consulting side, where a lot of founders, may want a marketing focused liquidity event, right? Where if they've got, for example, if a project's launching mainnet and they expect a lot of demand coming for the token, a lot of volatility, they may incentivize the market maker over a short period of time to increase depth to prevent, volatility or price to move against them. Now, when market making mixes with such consultancy agreements, that's when, trouble really happens, I think. A lot of big alts, this happened, and a lot of founders, they have no idea where their tokens trade. You can do a 7-day TWAP, like José said, and after token launch, and if you're lucky, that works out really well, and you can set sort of these thresholds at which strikes are set, where the market maker doesn't actually, make a lot of money, and there's not a lot of dumping on the market. What happened with, some coins just perform extremely well, and some founders make the mistake of negotiating strike prices before the tokens are already out. Now, that works against them, where the market maker, let's say, for example, a particular token, the strikes are set, I think, like 3 billion or whatever, and it traded north of 10. So market makers' options were, the call options were massively in profit. So if the market maker is going to do what they have to do, they have to exercise those options and take in the profit.
A couple of things. I mean, first of all, the incentivization of these guys is on the wrong side. That's what they need to adjust, because they're only looking for the upside and that's it, which shouldn't be the case, because what they're basically need to do is put bids and asks on both sides. and then hope for the best that the retail will come in and pick up those volumes at some point. So that's one. Lack of transparency is the other thing, because there's usually they use multiple market makers as well, so not one. And these market makers don't talk to each other very often. They're like separate entities and working separately on multiple exchanges, etc. So that's the second part. They should be talking to each other. And the only person who knows this is obviously the foundation and the exchanges. They know which market makers they are using. Nobody else knows it. And even us, we don't get that information on the secondary market as well. And they should actually announce that so that you can pick it up and see what's happening in the order book and whom is doing it. Because then you can actually call these guys out and say, like, what's the hell is happening here, guys? Why are these gaps here and what's happening here? So that's another thing. And some of these market makers, if the price dips too much, they just don't do much. They just take their hands off there and say, you know what, done. We're going to just wait it out till everything drops. And there are market makers out there whom we know as well. I mean, they're legit guys out there. They do the market making, even if it dips or goes much higher. They pick things up. So those are already a couple of things that we should be getting. More transparency is the key component here, to be honest, because that has been lacking on all fronts. That not only doesn't go to market making, but goes to us as well as OTC providers, secondary market, private market, the price movements, whatever. So, but yeah, that's that part of it.
And just to understand, so so now because I wasn't aware of that, but I'm assuming neither of your companies worked on movement.
We did. As you know, on our end, on private market, it's pretty simple. Even Taran and we need to do vetting on all deals. So all of the founders, we know them personally. We reach out to them. We check the softs of each investor, advisor, whatever you can name it. We are connected to probably all of those guys out there. So, and this price movement on the market making, etc., that we didn't knew, obviously, that it was that far and what was happening, because those docs weren't shared with anyone besides, obviously, I think the foundation and the market maker themselves.
So basically, so you actually were a market maker during that TGE, but you I guess you must have had a very different agreement with the foundation.
No. But it is we don't do the market making. We do the private markets. That's a totally different space. That is actually the secondary market itself. That means soft trading in a sense. So which happens usually pre-TGE or post-TGE as well. José, you wanted to add something?
Did Rushi OTC his move tokens? Is this
he didn't.
Fake news?
No, this is fake news. I mean, believe me, Jose, I've asked him multiple times on our end as well, because we also wanted to know the thing as well. And he mentioned, no, I'm not, the foundation is selling and the team isn't selling it. But the tricky part here, again, Jose, is he's saying something to us, obviously, to multiple other guys. But how can you verify that? And that's the tricky part in this thing as well. That goes for even the market maker itself as well. Even if he transacted those volumes, it could have been very well that it was the team tokens which were being sold at that given time. Nobody knows. And that's the tricky part again, transparency. So what I would recommend is at the beginning of these all allocation, just tag these wallets like, hey, this is the foundation wallet, this is the CEO, this is the co-founders, whatever, so that you can backtrack those and figure out whom is actually selling which kind of assets in on which wallet.
I mean, there's some issues with because we considered doing that for some projects that we were involved in, and we got pretty far down that. But then you don't really want to dox people, like people's wealth and stuff like this in this kind of format. Like it's just very uncomfortable for people, and especially, you're raising the bar even more to be a crypto founder. Like now you have to be comfortable with people knowing that you have 8 figures on chain or whatever. It's not ideal. So I do think transparency is really important, especially on the market making arrangements. I think Hester Pierce recently mentioned this, right, in her safe harbor rules, like the idea that projects would have to disclose market maker arrangements. I also think if the top market makers came together and just self-policed this way, like agreed to sort of open source their market making arrangements with projects, that would already be pretty good and probably force some change. It's just that no one's really incentivized to do this. Like both the market makers and the exchanges really benefit from the status quo, at least like short term, right? Like exchanges make money on fees. They make a lot of money on the low float, high FTV meta. They make a lot of money on these market making arrangements. And then I think the other thing that would be useful is having some sort of regulation around market making, similar to what exists in TradFi. So I don't know, for anyone who's caught up with TradFi, like it's changed a lot in the last 40 years. Because actually, if you read like Reminiscences of a Stock Operator, it's like a really famous trading book by Edwin Lefebvre, and he poses as Jesse Livermore and like talks about some of the stuff he got up to trading in the 70s and the 80s. And he was doing like blatant market manipulation, right? Like some projects some companies would pay him to exit their stock, and he would like paint the chart on the way up and get people to buy, and then he would dump on them like literally the stuff you see happening in crypto. And this happened. It was pretty widespread in TradFi, which is why there were rules against all of this stuff. Like there are rules against, you can't have spoof orders, right? You have to actually believe a trade is bona fide before broadcasting it. You can't have layering or spoofing. You can't trade ahead of customer limit orders, which, who knows if market makers are doing this or not. You can't like front run customer blocks. So there's all these rules around traditional market making, which would be very beneficial to have in crypto, especially in the cases where these market makers own like such a significant portion of the float that they really have a lot of power in terms of what they can do with the charts and stuff like this.
I mean, I guess, so when I hear you talk about this, about like how there needs to be a way to have this transparency with, the issuers, the market makers, like, immediate, and even just the fact that you're bringing up Hester Peirce, like, she's US based, and like the chopping block just did an episode about what happened with movement, and Evgeny Gayvoy of Wintermeat was on there, and he was saying like, oh, like I don't even know all the market makers. There's like a bunch in Asia that I don't know at all. So like whenever I hear these things, I'm like, okay, but how do you do that? Because like in a way, it's almost like we're in this digital world where it's global, but then like the meat space world of regulations, it's all like divvied up by country. So it sort of feels like there would need to be some kind of like, supranational crypto organization. And then you have to get like, I don't know, all these different people that are in all these jurisdictions. Like, how do you enforce that?
Now, the thing that you mentioned, the chopping block, obviously I was listening into that one as well. And the thing that Evgeny mentioned as well during the pod was that he, Salini, and GSR, a couple of other big guys, it would be probably smart to just build up an alliance between those guys so that they can build as an example to everybody else out there, because that would be the smartest thing to do, so that they can set example and set rules for everybody else to follow. Because right now, nobody knows what's happening under the hood, just to be bluntly honest. And that's the tricky part.
But what I'm trying to say is like, because if you have like I could see that creating a sort of race to the bottom scenario where the players that are less ethical will then just know, okay, let's not use those people. We'll go to like more shady type of outfits. That's why I'm like, I don't know how you would really, tamp this behavior down.
I think on the regulation side, the easiest way to do it is on the exchange listing side. Right, like make because you can enforce these obligations on exchanges to say that you have to, your projects, the tokens that you list have to be working with like market makers that are regulated or that you've sort of ensured are following these best practices. And I think that's the easiest way to do it, because that will effectively force any token that wants to be successful in crypto to kind of do this. I also think self-policing is like underrated. Like audits work, right? Everyone has to get an audit these days to get listed or to get investment, and there's no regulation for that. It's just become a social custom that you don't want to invest in a project that isn't audited. And similarly, like it matters who audits you, right? Like the famous is it Zelig, like the famous Zelig audit, like reverse signal or whatever. Like if people are using shady market makers, it's going to end up reflecting poorly on them. So I do think there's self-policing we can do. And I think on the regulatory side, it isn't so hard because the centralized exchange is sort of the place where you have leverage. They all want to serve US users, and the US has historically been pretty hard-handed and if you serve US users, regardless of even if a US user uses your thing, it's in US jurisdiction, right? And so I think both of those are like paths that could work.
But just one question about what you said about, like, I forget how you phrased it, but it was like everyone should know your market maker. But and like certain ones would be in places where they're regulated. But like, what if you just know which ones are not regulated and then you just choose to use them, and then that market maker is also not incentivized to publicize that you're using them, so you could still get a situation where, yeah, they're using some of the legit ones that come with good reputation, but that they're simultaneously using ones that like are just shady. Like, how would you know that? Or how could you?
I mean, I think in the case that I was talking about, it would be like the exchanges themselves. So like maybe I haven't thought about this too much. So I'm just thinking on the spot about the regulation specifically. But if you had like a list of regulated market makers effectively, and then you would have to certify that you're using only those, right? When you launch with a centralized exchange, and then if it turns out you're using a shady one, that's fraud, right? You've lied about something, and so yeah, I think there's ways around this, and also like you can work with multiple market makers, but realistically, there are only so many tokens that you can loan, and there's normally like one market maker or two market makers that are taking most of that. So it's hard to like pretend you're working with two legit market makers and then actually work with a non-legit one under the. I'm curious what Taran thinks of this. Actually, maybe you've probably seen a lot of this stuff.
Yeah, so I think I'm going to take the market maker side here because like it's very difficult if you shade, if you sort of bucket market makers into just two discrete buckets of being shady and non-shady, right? Now, how can unregulated exchanges, how can they expect their their trading entities to be regulated? That doesn't make any sense because the top three exchanges are all unregulated. Binance sure does some volume out of the UAE, but the majority of their volume is still offshore. Same with OKX, same with Bybit. The only one is probably Upbit, but that's spot markets only, and only a limited circle of market makers have access to clearing markets. Now, that's first. Now, also without market makers, I think the space would be a lot worse. That you can see on chain. Even if you trade, let's say you trade on Solana, right? I actually just 10 minutes before this podcast, I had a pretty large order I exited, and I took 22% slippage on a 7-figure transaction, right, on chain. Now, that's ridiculous, and obviously market makers would make that a lot better, and they should get paid for it because they're saving all of the traders a lot of money, going in and out of positions. Geographically, it becomes a big issue as well. Which jurisdictions should they get regulated in? It also increases the barriers to entry for new market makers and trading firms. Competition is obviously healthy. Probably like the top 7 market makers have 95% of the industry, right? Some European market makers are coming up, but the top 7 just take up the majority of the business. And small market makers need to start somewhere, right? And they can only start if they spend 3 years trying to get licenses before they can even trade. The opportunity cost is too large. They're giving up a lot of potential opportunity to also their competitors, so they're giving up competitor advantage. So yeah, I think we can add layers of transparency, mainly between the founders and market makers. I think the responsibility should be with the founders, right? Exchanges they should have responsibility, but onboarding with Binance is like pretty hard anyway for any entity. It takes 2 to 3 months. They have a lot of DD. I think they're pretty good with their due diligence, and they're also very good at enforcing. They kicked Web3 port out, for example, from Binance. But they're going to realize there's going to be a new entity with a completely new UBO signing up for Binance in the meantime anyway. So you can't ever kick these people out. And why would Binance do that? They're giving away, potentially another 50 billion monthly trading volume just by kicking away one trading firm. And they make their money in trading fees. So I don't think it's as vanilla. I definitely think founders need to be more responsible, right? We're talking about movement here anyway. I mean, 5% to one market maker is ridiculous, but they had incentives. They had a motive. They had an ulterior motive. What they wanted to do was build up cash in the treasury. Now, movement was more of a social issue, I think, rather than a technical issue. The token in December was like, everyone was talking about it in January and December when Trump got sworn in. 14 or 12 billion FTV. Rishi was a god. He was taking pictures with Eric Trump. Everyone wanted to be Rishi. Even now, movements, I haven't checked, but it's at 2 billion FTV. It's still a dream come true for new launches, right? And they, for example, another document came out, showing who actually signed the documents with the market maker and who was actually running which one of the co-founders was actually running the show. So yeah, they made a lot of social mistakes, structural mistakes inside the company. They gave up the control of the foundation to someone else that they shouldn't have. That was all a shit show, and I think that's the reason why movement should probably just go to zero.
Wait, and I'm sorry, you're talking about the friend that was like, that didn't have I'm just forgetting his name for a second, who didn't have an official position. Is that who you're talking about?
No, again, back to Jose about incentives. You can go on this, Vana Chalma Mosey, his Twitter. He tweeted about it first. I think some press covered it as well. The document with the report was not signed by Rishi. It was signed by someone else on the team. I'll let you find out who. But it just shows like he can't do anything. He's tied up in legal battles everywhere. It's a shit show.
Like, so we talked a little bit about like all these different problems. What would be kind of the best way for this to go for all the participants involved?
I think that the main thing that would be most important is transparency. So, the retail being able to know who owns what tokens, which is already pretty clear in most projects, although not all. The market making arrangements, so how many tokens were loaned to market makers, if there are any option agreements, what are the strike prices, just having that be open sourced. And then like what the real float is also a huge issue. Like projects are inflating their floats to make the token seem more like the valuation seem more real than it is effectively. And then I think that the last thing, so real float would be also like what tokens are actually unlocked, because a lot of the times people think that insiders are all locked, but the foundation treasury or the labs treasury are not unlocked, right? And they can actually sell on launch day, and oftentimes they're doing that through market makers. And for the more shady projects, I think what people don't realize is that is a way to soft exit the team, because what you can do is you can sell from your treasury on the day of launch, and obviously that's the day where there's maximum hype. It's normally, unfortunately, for a lot of tokens this past cycle, the maximum price too. Projects can exit large amounts into a lot of launch liquidity, and then they can take that cash, wait a year, and bid on the team cliff day, right? And effectively, they're buying back like the team tokens a year later. So it's sort of like a soft exit for the team. Or in some cases, what protocols will do is take that money, use it to pump TVL in their own protocol for a year, and then when the unlock happens, take the money out of their protocol and use it to bid tokens and effectively like soft exit the team. So for me, like the most important thing is just that there would be transparency around all these arrangements. And then secondly, I do think it would be useful to have more unlocked tokens on launch with a cost basis. So I think if ICO platforms like Legion, which we incubated, or Echo and some of these others become more mainstream, I think having some of these unlocked tokens with a cost basis, or because like Launchpool doesn't achieve this either, right? It's Binance Launchpool. It's unclear. There's always like $15 billion of capital farming in there. It's unclear how much is, real people's, how much is just Binance farming this for themselves. And so it would be really useful, I think, to have some of these like public sale mechanisms too. So for me, it's just having more of a float, having transparency around the real float, market making arrangements and everything else, I think is sort of the main thing that we need.
Omar, Taran, do you have any thoughts to add?
What I would do as a start is adjust the whole fundraising thing, just to begin with that part, because the issue that I see there is all these projects are building several stuff. Obviously, they're gathering fundraising as much as funds to build up a whole ecosystem. And that's where this whole valuation things move to a range where most of the retailers don't want to buy things. They're like, you know what? If you buy it at that, it wouldn't be a good thing. Movement, for instance, it was at 14 right now at 2. Those guys are like 10x lower than what it is right now at this moment. So that doesn't help for those guys. First of all, that would be one of the core things that we need to adjust on our end. Don't go and build up ecosystem fund and move this valuation to a skyrocket 3, 4, 5 billion, which doesn't help anybody, in my opinion. So that's the first thing. Lower that so that retail can actually jump on and buy assets at a lower valuation, much lower. I mean, Solana, AVAX, all those things raised like 300, 400 million valuation, and they're still doing phenomenal at this point. So maybe go back to those points and build it at that moment in time. Second thing, but José mentioned about ecosystem fund. That is a tricky thing because we see that on our end as well. Projects using those funds to build up a treasury. And then they're like, how should we do that? Should we give it out to a market maker? Should we do OTC? Should we do other options? And then they reach out to us. They have a chat with us. And then we always advocate them to do OTC because that way you have strategic alignment with the people whom you're actually buying instead of just using it for a market maker and selling those positions. I mean, Celestia did the same thing. They raised over 100 million at 3 billion valuation post launch and everything. And right now it's still trading pretty good. I mean, I know Taran and us, we traded, millions in Celestia, if I'm not wrong. So, and it goes back to a lot of other assets as well. So there needs to be a bigger picture of how can we do this to build it gradually, to build up the whole order book organically, instead of just going and putting bids and ask and hoping for the best, because that doesn't work down the line.
So in a moment, we're going to talk a little bit more about like other ways to make these types of token launches happen in an ideal fashion. But first, a quick word from the sponsors to make this show possible.
Hi, I'm Matt Hogan, CIO of crypto asset manager Bitwise. Look, crypto can be confusing. There's so much noise and the space changes so quickly. That's why, every week, I write a 5-minute memo on the biggest stories impacting crypto, in plain English. Why is Bitcoin up or down? What are people missing? Where should investors look next? Get the lowdown every week. Sign up to get the weekly CIO memo delivered straight to your inbox. Go to bitwiseinvestments.com/CIO memo. That's bitwiseinvestments.com/CIO memo.
Carefully consider the extreme risks associated with crypto before investing.
We have another listener comment, this one in response to our recent episode on the stablecoin bill's stalemate. In particular, Kristen Smith's statement that she'd rather deal with the Trump family than with Gary Gensler. On Farcaster, Sterling Schuyler wrote, "From the policy side of things, I can understand her point, but damn, is this really the timeline we live in?" We agree, the timeline is wild. Tell us your thoughts about it on YouTube, X, or Farcaster. Back to my conversation with José, Omar, and Taran. So when I hear you guys talk, one of the things that I keep thinking is that in a way, a lot of this action it's to take some token activity that may not be organic and have it end up following the path of something that is more organic. Would that be like a fair characterization? And for like all the different participants to win. So the initial token buyers, the team, like, is that kind of a way to characterize it?
Yeah, I think for me, maybe even more than organic, it would be transparent, because I think, Sunlight fixes a lot of issues. And, if these inorganic arrangements where if you see that the real float is 5% and market makers have been loaned 4%, then retail can sort of see and people can start tweeting about it and stuff, that this price action is not going to be organic, right? And so it's sort of, I think, naturally fixes these issues. But definitely, I think there's also a lot of inorganic stuff that's the problem here, launching at high valuations and stuff like this. But I do think transparency, to me, is sort of the most actionable solution to fixing this.
So I can give you the trader's mindset. Last cycle, there weren't too many coins, right? Whatever you bought still kind of went up. in 2021. This cycle, there's just way too many infrastructure coins. And back to Omar's point, which is correct, too much venture investment. Most of these VC funds are down. Most don't have DPI. Most were sat on huge UPNLs. They didn't sell last year. Now they are texting people like Omar and I to sell because they want to get money back to the LPs so they can rinse and repeat, raise the new funds. Now, as a trader, if you want to go, if you want to buy things and if you want to hold things, asset selection becomes like 10 times harder. Not, I think the real math is like 1,000 times harder because there's probably 1,000 times more coins to buy. Now, that's obviously not good. Now, if you look at people actually buying things and holding, most of the altcoins, went down 90% between, Q4 2023, Q1 2024 and Q3 2024. They had a bit of a run late 24, but now most of it down again, 80, 90%. Right? Some of the altcoins are returning now, but they're still down massively. Some are returning back to their all-time highs. Virtuals is now only down 60% from its all-time highs. So traders now want to make sure that they're trading, and it's very hard for them to buy and hold things. So as a founder, they have to consider this. They have to consider that, actual, buy side is just, fragmented is a very popular word to use, but it is, right? Buyers don't know what to buy. They can buy something, but they will rotate out very quickly. From a risk return point of view, it doesn't make sense to hold anything anymore. If you're buying things OTC, majority of guys, like, the sort of assets traded by us, the lock tokens, in 2023, people were buying things and they wanted things OTC and they wanted it for cheap, and they would hold it for the entire maturity of the trade, right? Which means holding it for multiple years. Their P&Ls were huge, but then obviously drawdowns happened and they realized, they should have hedged. Now, the second time alts ran, a lot of people bought stuff, at 70, 80, whatever percent discounts to spot prices. This time, however, they hedged their exposure. They remained completely market neutral because they didn't want to go into naked longs anymore. There's too many coins to allocate to, and they want to take advantage of perps, which are by far crypto's probably top 3 greatest inventions. So I think that's something founders have to keep in mind. They have to launch coins. Movement launched a coin without a chain. They wanted to treat mainnet launch as one of the catalysts that pushes the token price up. Which actually, it makes sense if you understand incentives. Even the team members are sat on a 1-year cliff. So, but for them to make any money, the tokens need to be worth something at the end of the 1 year. So they need to have some chips in their pocket to play by the time the vests happen. Solana and AVAX have, they came out in different markets altogether. They became industry leaders. They're going to stick around forever. They're one of the top 20 coins. But new coins is very hard, right? The most successful coins this cycle had small floats. Athena is probably one of the only coins which,
Sui, by the way.
Suri was a big winner this cycle, right?
Still is.
Yeah, and Mantra and Ondo, right? Look at every founder wants to, up until Ohm collapsed, every founder was texting JP as to, they wanted to run the same playbook. The way JP handled it was genius. The guy's a genius. Up until he wasn't, right? And obviously everyone in hindsight, everyone was, predicted on his downfall apparently, but in reality, all the founders wanted to run the same playbook as Ondo and JP. Ondo's zero float, again, sub 2%. The largest holder of Ondo is Columbia University. They don't even have a wallet. They can't even claim their tokens, so they're never going to sell, right? The large funds, they've got side deals going on with foundations to make sure, despite the drawdowns, they can still manage to not destroy spot markets completely.
Wait, I'm sorry. This thing about Columbia University, I am so unclear about this. How could they receive that money if they don't have a wallet?
No, exactly. They're not going to sell.
But like, why would they do a deal where they can't get the money? I don't get it.
I don't know, but it's a public source. They have a lot of tokens. They're one of the largest holders of Ondo. They will just never sell. Again, the largest holders are 2 of the major VC funds in crypto, the founding team members, and most of these guys control a lot of the liquid float. After the big unlock in January, Ondo just doesn't have any unlocks up until January next year. Right? We actually just did a trade last week. That's why I'm coming to Ondo, because there's just no float. Perp markets are still healthy. The spot order books are still very illiquid. I can look at depth, but They're also very well capitalized as a team. And the token probably keeps going for a lot longer, and it could become one of the major shorts if it has a god candle again. So it goes back to Jose's point about artificial token metrics. There's no floats. Mantra had no floats. The guy got all of his money, but doing these OTCs, he just extended the sell pressure to OTC buys. It's called the time arbitrage. He extended the sell pressure to people in the future, took that money and bid spot now into empty order books, right? It pushed up the price 60x from, 100 million market cap to a 12 billion FTV, right? It went up over 100x because he was just taking 20, 30, 40 million or whatever, however much it cost him, to bid into empty order books, pushing the price up artificially and blow out the shorts because a lot of people were betting against Mantra.
So earlier when you were saying that everyone was wondering how to do what he did, like, were you saying that you feel like he figured out something that should be emulated, or are you just saying that people are just in it to make a quick buck and they don't know what's going on, or like what do you think of what he was doing?
What do I think of what he was doing? I think his playbook was pretty genius. It was also one of a kind. Founders wanted to emulate it because he was the founder of a $10 billion coin.
Yeah. I don't know. I'm not commenting specifically on Ohm because I honestly don't know the details there. But I don't think if you lie about your float, it's not really like, I don't know. I wouldn't. I get what you mean by genius in the sense of
well, instead of founder incentives, that's what I meant. All founders wanted a $10 billion coin. So in their eyes, JP was a genius because he manipulated. Legally.
Yeah, but in traditional markets, this is like fraud, right? And market manipulation, like if you lie about your float, and also like people would not have acted that way. I mean, who knows? But people are entitled to have the right information, right? Like if it's a tiny float, you don't get. You probably get people being more careful shorting if they know the real float. You probably get not so many people bidding if they know the real float. Obviously, a lot of this Saudi money that came in near the top probably wouldn't have done that if they knew what the real float was. Or yeah, maybe not. But I think this is the thing where it's like, I don't know. These games are a lot harder to play with transparency. Like transparency is the best disinfectant, and that's really what's missing here. I think because
I disagree with that.
You don't think so?
No,
think
because
people will ape anyway?
All the facts were there, right? You could go into Mantra's wallets. You'll find one cluster with like 87% of supply. Back then, 90% of supply in one cluster. People just don't want to research. Traders want to make money. They're gamblers.
Yeah.
90% of retail participants.
But Taran, there was one thing which you and I both didn't even knew, is that there were multiple vestings. Those vestings weren't announced. So multiple different vestings. And that's the tricky part of this whole thing.
And CoinGecko is sort of like the canonical source of information, effectively for a lot of traders. If you go on CoinGecko, the real float looks like it's like 50%, right, or more. Like that's what CoinGecko basically reports, which is obviously not the case. And that's the problem. That's what I mean by transparency. Is like a lot of these projects will tell CoinGecko like to count the treasury coins as part of the float because they're like circulating and unlocked, but realistically that's not part of the float, right? Because they control it and they're not going to sell it. And then you start playing these games where people think, oh, this thing is 60% out there, but actually 55% is sitting in treasury and team controlled wallets that will never move. And the real float is 5%, 4% of which is controlled by a market maker, right? And that's where the in my mind, like the fraud starts to creep in.
Charts, Jose, right? Like a $1 million buy pushes the price up 5%. The depth just wasn't there. The order books were empty. If traders did more than the token, because technically the tokens were unvested, that technically does count as market cap, right? That's what these guys think. Now, if they go into the order books, they'll see there's just no tokens in there. So a lot of shorts did get blown out. First time Mantra crossed $1 billion, I knew a lot of people shorting it. Those guys get stopped up, and they never shorted again. The same story was with WorldCoin. Right, early last year, WorldCoin was like 120, some stupid FTV. Real market cap was probably like 500 million market cap. Right, it was the smallest float anyone's ever seen in crypto, probably ICP back then. But WorldCoin managed to play those games. WorldCoin's still around. It's still kicking at a 25 billion FTV. Retail traders just don't want to do any research. Is the reality of things. And then founders thought of JP as a genius. JP, I don't think is a quick extractor. Respect where respect's due. The guy was selling his watches at the bottom to buy back his coin to make sure his company survived. He was doing equity. He was raising money with equity fundraising. He actually is an amazing founder.
He still is, by the way. I mean, he's trying to
He
recover
still is.
the whole thing at this point again. It's not an easy thing to recover from that positioning itself as well. But
Yeah, but
go ahead, Lara.
Honestly, I feel like maybe I think José and I have like a similar view, and you guys are maybe a slightly different view, which is like even Taran, you said the word he's an amazing founder. I think you used the word startup. Like that's kind of like a centralized view. Like if José and José, correct me if I'm mischaracterizing your stance, but we're talking about like a whole network or communities, like a more ground up type of thing rather than like, a top down. Like the way you're describing it sort of reminds me of Do Kwon. Like, I know I am responsible, or, yeah, it's like the difference between like Bitcoin versus like, Richard Hart's, whatever, I forgot the name, Hex, like that's, am I right? And I know I'm talking about extremes, but like, don't you see there's a difference there?
No, I think what I think, Laura, is, and I'm pro transparency, definitely, because from my perspective, they should tag those wallets from market makers to foundations so that everybody knows what's happening on each side and give the vesting out. That would be the most clear thing to do so that we, even on our end, on private markets, understand what's going on. But people definitely need to do their research. 100%. I agree with that on Taran's points and probably Jose as well, because that is what's lacking at this moment. People just ape into things. I mean, that's why all these meme coins were blown up at that given time. But the other thing is founders need to evaluate how they actually position themselves in this space, and also go back to their employees, go back to their investors as well. Like, hey, what are you looking for at this moment in time? As an employee, do you need to have money back, for instance? Do you need to sell your shares? Do you need to do proper OTC if you want to buy a house, etc., etc.? Those things are a bit taboo in crypto in general. Nobody's talking about those. They're like, no, you can't just sell your tokens. It's not allowed. Wait till you get your tokens and then you can sell them. And that's where all the sell pressure comes. It's an emotional pressure. And then they do things which they shouldn't be doing, like these market making deals, etc., just to build up a treasury, which they need down the line. So that's the thing that I'm actually trying to make. The point is there, like, let them sell whenever they can sell to build up their own stuff. Other thing, for instance, DYDX, the employees were waiting like 4 years to get their tokens and their money. And they were building this project like 4 years on a straight row. And they got normal salary, that was it, but nothing else. And then they launched the mainnet, started trading at $4, and right now it's well below $1. Around that time, we had like 30-40 million buyers on our end on private markets. And the team was like, no, we're not going to sell at this moment, so pass on the whole thing. And then what happened there is a cascading effect. The price dropped from $4 within a time frame of 2-3 months to below $1. So that's what we are trying to make a point. Like, hey, reevaluate your strategy. Instead of just using a market maker, there are much better strategies out there than only doing it in that manner.
Yeah, well, before I ask you more about those other strategies, I do just my personal take is, so I understand what you're saying, Taran, about how like this was all, they could have checked on chain, like there are tools that they could use. It's not the fault of, JP or whoever if the traders aren't doing their own research. Like I understand, like, of course, we're all adults and, everybody's making their own decisions. But I guess I would say that like, just because like for most things in life, just because you can do it doesn't mean you should. Like there is something slightly exploitative, I think, about that attitude. Like, yeah, personally, it probably is better to like create a project that people actually want to participate in. And it's like more like, an actual ecosystem that kind of like has value that raises the price rather than just like, what games can I play to try to pump up the price? They're two different things.
Yeah. I agree with that, honestly. Like I see the other side too. Like people don't do any nearly enough research, and obviously we own like a research firm, so kind of talking our book here. But it's like it's kind of hard to expect people to, if they want to ape Ohm, like go learn how to use a Cosmos block explorer and like identify the deployer wallet and see the clustered addresses, and then and then go look at the order book depth, especially because there's a lot of spoofing on these order book depths. Like maybe it worked for Ohm, but it doesn't necessarily correlate to every token, right? Some tokens, the liquidity looks a lot thicker than it actually is because there's games being played there. So I do think having transparency and some like best practices, which I think the exchanges have tried to enforce, and they've learned and gotten better at that over time. But I think improving that is really the best way to create like better conditions for, because ultimately I think what you want is for these like basic games to be, so for there to be transparency so that these basic games get punished and then everyone launches in a more like rational way, where if you like a project, you can mostly just buy it without having to worry about, okay, is the float, am I being gamed on the float? Is there like a ridiculous amount of issuance? Is there some strange unlock happening soon? Like, and obviously it's going to be hard to get there because we're literally giving liquidity to early stage startups, and like these same issues play out in early stage startups just behind closed doors in OTC markets and boardrooms and stuff like this. But I do think we can and we have done better, and I think it's going to keep getting better. But yeah, I think some more transparency would be super helpful for people, or at least like CoinGecko, because I think that is the canonical CoinGecko, CoinMarketCap. These are like the canonical sources for most people where they go check before, if they even do that, right? Most people probably just look on Binance and buy it there. Like if they're a bit smarter, they'll go on CoinGecko or CoinMarketCap and look at the market cap and be like, okay, this thing is 60% distributed or whatever. And then like a very small percentage will go on chain and actually like verify stuff and check the order book depth and things like this. So I think you got to try and make that a little bit easier and not have people play these games. But
I have 3 points. I mean, the problems you describe are not exclusive to crypto. If you go to any alternative market and trade on the public stock exchange, almost like 90% of the stocks play the same game. Those stocks probably have retail participants. I think retail participants are probably down like 90% from 3-4 years ago. Crypto is just PvP right now. One trading firm trying to profit from another trading firm. One market maker trying to take out like a prop firm, like who bought a bunch of tokens on the open market. Yeah, I think retail bitch is completely gone. Back to my point, when I said JP is an amazing founder, he has been building for a long time, like a long time. Mantra and I think Soma, Mantra and Soma have been around a long time. I think since 2019 or something. Mantra is also a second cycle coin.
I did the ICO turn just to give you an idea. That's how far they go.
There you go. Yeah, long time ago. And but by what I meant, amazing founder, lots of founders. Up until the token crash happened, hindsight, we're all geniuses, right? Hindsight Capital is the best performing hedge fund of all time. But at the time, every founder wanted to emulate what Ondo did. Sui was a different story. What Ondo did, what Mantra did, they wanted to emulate that. Because at the end of the day, founder incentives are make the most amount of money possible. Crypto has become this industry that participants in the industry and people joining the industry just want to exploit the participants, right? If you look at, some new firm trying to offer real estate to crypto people, for example, in Dubai. End of the day, that's extraction away from the crypto industry. They want to extract from crypto participants. And that's something I think we're straying away from the true ethos of crypto. You can build great products and your token will not catch a bid. Look at D-Bridge. I think D-Bridge is one of the greatest bridge experiences ever created in crypto, right? One of the best app use cases in crypto. Tokens at 30 million market cap, right? But the founder, Alex, he's one of the best founders I've ever seen. But at the end of the day, these guys, they're making good revenue, but, they see people, like some coin out there, out of EA coin, 5-10 billion FDV. The founders are in a position to cash out 8-9 figures, and they're like, it's tough. It's tough coming to the desk and seeing, a meme coin trader make 20 mil from one coin called GOAT. And you think to yourself, what are you in it truly to build, right? It becomes really, it's just human psychology, founder psychology. It's hard, man. I think it's a deeper problem about crypto's ethos.
I have to I push back against it a little bit. I definitely think there's a lot of that, and probably I think maybe from your guys' lens and position in the industry, you see a lot of the underbelly. I think as a VC, you also get to see a lot of the really ambitious founders that are trying to build something for the long term. And I think there are like a lot of examples of that. Just people building in the background, like not really worrying about short-term token price, not playing PvP. And it's also like this mentality, and I heard you say it recently that like, or the fragmentation, right? That more tokens is there's like, there's more fragmentation of bidders and stuff. That kind of implies that crypto is just like this zero sum thing, right? It's just gamblers aping capital into this zero sum thing. And if there are more coins to ape into, then each of them will be less valuable. But if we're actually building technology here, which is what I think we're doing, then this isn't zero sum, right? It's positive sum. Like there will be massive outcomes from people creating the world coins, the identity layer of the future, the dexes, the uniswaps, all this kind of stuff will be massive, like positive sum outcomes. And like you wouldn't say this about the stock market or about venture, right? There are too many companies like to invest in. It's not a thing that it's not terms in which people think. If there are more companies, it's a good thing because you have more economic value created, more founders trying to do cool things. If anything, we have the opposite problem. There's too much capital chasing too few entrepreneurs. So I think it's the same thing in crypto. Like there are a lot of coins, and I think a lot of them will go to zero, which is exactly what you'd expect if you did the same thing in startup land, gave like liquidity to startup shares. That most of them would go to zero. But I do think there are really good founders building stuff for the long term, and I think, or I hope in the long term, those people get rewarded. And I know you guys are trying to help those good founders play the token game better as well, so they don't. So because success is path dependent, and oftentimes launching your token badly can really hurt your prospects because you can't recruit the best engineers and stuff like this. So yeah, it's tough, and we're all learning as we go. But I remain hopeful, and like a lot of the founders I speak to, especially recently, really get me more excited.
Yeah, I feel like there's problems like at multiple stages because you could say kind of for like I've been in crypto for 10 years, you guys. I have seen this happen so frequently where people they like launch something and like maybe they've done like some amount of good, but they don't make whatever they say that they're building a real success, but they at least now suddenly have enough money where they can kind of chill out for the rest of their lives and like live a pretty nice life. So it's sort of this, like, even though I kind of dropped out and I didn't do anything for my community after a certain point, like I'm going to be sitting pretty for, the rest of my decades. And like, so there's one end. And then, some of, I feel like what Taran is talking about is like this more short-term attitude where it's like, well, if people aren't doing the research and I see how all this goes, like, I can make money again in that way where like, I don't maybe build something. The long-term thing is like much harder. And even José, I feel like you referenced this where you were talking about how, for all the different participants, like there's different things that they wanted. For the founders, they want the quote unquote soft landing when their tokens unlock. And, what you mean by that is like, they want to make money, which like, there's nothing wrong with it. Like, of course, we live in a capitalist world and there's definitely nothing wrong with making money. But it's this issue of like, well, like you want it to be when there's been like a success kind of for the community and not, or for the community is even strong, but just like something that is more self-sustaining, then it's like you kind of got it off into a liftoff phase where like, as long as, all of these different diverse participants in this decentralized community are all invested, then it will keep going. And so, yeah, it's just like, I was trying to think of like, what are all the different ways in which that you could kind of revise the different, factors that would result in an unlock. And yeah, there's so many different things, but a lot of them, other than time, can be gamed. So that's why, I think we're just having this discussion, and yeah, it just shows how complicated it can be.
I think this whole thing starts obviously once VCs and founders have a chat with each other and the fundraising starts. From that point on, VCs want to build a solid tech. That's their core vision. And I think if they build that, there are certain participants whom they also need to think about as well. Investors is the first one. I mean, Jose, you guys put in an X amount in each and every protocol, and end of the game is you want an X amount of return back as well. It's not a charity show, just to be bluntly honest as well. You have your LPs, etc. as well, all over the place. So you need a return. So they need to think about, those founders need to feel obligated that they need to think about the tech, but also about if they launch a token, that it needs to perform to a certain degree. Obviously, they can't just move it up the way that some projects do it. So they shouldn't do it in a bad manner, but it needs to be something that they definitely need to think about, or else they should just do equity and move on and do something else. That's the other portion of this whole thing, because it goes back even worse, because this goes to market making, this goes to retail, because you're hurting those people down the line as well. If you're not serious about launching a token, you shouldn't just do it. You should just stop there, build a tech, do an equity basis, and move on. Because the obligation on the founder side is much bigger. And it's all about the reputation of crypto itself as well. So if you are a founder launching a token, think about the consequences down the line, not only for the VCs, the market makers, but also the retail. Because if they don't feel comfortable, they wouldn't come back. They're like, you know what? You're done with this whole thing. You're going to move on and do something else. The other thing goes for VCs. VCs invest in something, they want to have a return, but they also have this obligation towards their LPs, but also towards the rest of the market. They should ask their portco to be more transparent. Just post the vesting, etc., whatever you have. Post the funding rounds, like, hey, we have done 3 funding rounds. These are the prices, etc., etc., all the information. Believe me, the amount of time that we on SecondLane spend into getting these details, it takes us sometimes hours to figure out the vesting. And there are all these side deals as well happening with large VC funds. I mean, Eigenlayer did a side deal with A16Z, for instance, like at 2 billion, 100 million, etc., etc. It came out like months later when the funding was done. Those are the other things. Most of the people don't even know about it. We know it, obviously, but retail, they don't even know it that happened. They just posted like A16Z invested in Eigenlayer. That's it. Done. And then we move on. Nobody talks about it. So those are other things. And there are multiple things, retail, employees, etc., etc. There are multiple layers. And you need to think about all those layers as a founder. And that's the core thing that we are actually advocating. There are so many things. And liquidity is one of the core things, obviously. And everybody's looking for it down the line. Obviously, transparency is one of the pillars of that, Jose, definitely agreed. But liquidity is the key thing, and you need to think about that on all fronts, definitely.
I agree with that. I mean, we're definitely not. We don't have external LPs, but we're definitely not running a charity. We want a return, and that is something that's sometimes misaligned between VCs and founders. Have this misalignment where for us we have a portfolio of bets, and we want each one of them to be as successful as possible. For a founder, they have one bet, right? So if this thing is trading at some large valuation in which their share represents like life-changing money for them, they will want to take chips off the table, right? It sort of makes sense for them, but for the VC, purely rationally, we wouldn't want that, right? We want them to have maximum skin in the game, so they want this thing to succeed. But you have to sort of find a balance between that, and in I think a lot of this can be solved by learning from TradFi, actually, like some of the like legal frameworks that exist there. Like in TradFi land, founders have control shares, right? And control shares have way more requirements around how you can sell them. Like you need approval from the board to sell your shares. It's not like investors who can just OTC their shares. Like founders and other people who own more than 10%, I believe it is, have different requirements around. And I think we basically need to learn like and implement like these kind of TradFi lessons onto the crypto somehow. And I mean, I definitely agree with the VC deals being transparent too. I think that would be really good if there were just if it all happened on chain. Gabe Shapiro from MetaLex, who we incubated, is trying to make that happen. It would be great if all of that was on chain. If the side deals were like, again, side deals is something that in TradFi you just have to disclose, right? To your lead investor, you have to disclose if you have any side deals. Like, that should be standard. Like all the liquidity deals that projects do with people should also be disclosed. TVL pumping deals, like, so yeah, to me, it's just creating these standards and the kind of learning from TradFi, so we can stop a bit of these games that get played.
Much better than TradFi, to be honest, as well, because on our end, everything is on chain basically, so you can just build it up, show it so that people don't read through it. That's the most thing that we have. But yeah, reading it is the difficult part of this whole thing, because it needs to be translated to everybody on common knowledge, like 1 year cliff, Delphi resting, instead of going through code and reading the code, because even I can't read the code, just to be bluntly honest. No, it's not possible.
All right, so we're coming up on time, so I just want to ask, like, so basically in this conversation we had, we noted kind of, I don't know if mistakes is the word, but we noted ways in which all these various participants could be doing things better, from VCs to the token issuers to the market makers to the investors themselves. Like it's kind of like all over the map. So, when we're in this phase where we don't have kind of the regulatory or even self-policing organization that we discussed earlier, like, and Frank, another participant would be exchanges. What kind of like ways do you think each of those different groups could improve? Like if you were to give one tip, I don't know if tip is the word, but just like one wish that you had for how those different participants could do their part to improve this situation.
Let me start with the founders themselves. So besides building a protocol for, let's say, the community, the investors, market makers, partners, whomever you can think of, they're building a solid tech. That's their core vision. Besides that, think about liquidity for everybody surrounding you. And what are you actually building? Are you building it for a product market fit? Because that's the core thing. What I see on my end is people just raising a shitload of money in order to create a market fit, which they shouldn't be doing, because you should figure out if the thing that you're building, that it has market fit or not. That's the first core question there. On our end, for instance, SecondLane, we had market fit, and then we went on building this company the other way around. And people should do that. People should just raise 1 or 2 million and try to figure out if you can have market fit through that fund, instead of going like raising another 50 million from VCs and promising that they will get you the next 100x, because that doesn't work, in my opinion, in my humble opinion. Let's put it in that manner. But yeah, that's what they should be. And obviously, to José's point, definitely agreed. More transparency on all fronts, from VCs, from founders, from market makers, from exchanges. Why the secrecy? Just be transparent so that everybody understands the market much better than what we do at this point. And we are trying to do that with our monthly reports, posting them out on each and every month, just to give you an idea of what kind of order book is moving from on private markets, what assets are moving from A to B to Z. And that does help, obviously. And they should be doing the same thing on their front.
I mean, for me, look, it's a very difficult game. I think human psychology and, founders looking at other players in the industry get massively wealthy by extraction. They got to keep their values up front. At the same time, keep building things that people actually use. It's very important. But, it just, people do need money to build, lots of these big layer ones and tech companies, they spend 1 to 1.5 mil a month on devs. They need that much money. Eigenlayer is still paying their like 2 million a month, I think, in salary. I think that's the paying math. But their token was worth $1 billion, I think, a couple of weeks ago. And, these people don't cut. Foundations become founders' family offices, for example. We're seeing that in the second cycle now, where founders have lost most motivation. Foundations are used as these just financial powerhouses that founders can use on their whim. All of that, I think, needs to stop. There's ghost chains still alive with billions of dollars in assets doing nothing. It's great. I mean, Ripple is amazing tech, but no idea what they do. They're the largest altcoin. Yeah, it's very, very hard to be a founder in crypto these days. Lack of a retail bit is very apparent. Meme coins are up more than most alts this week. AI coins are up more than most altcoins and infrastructure coins this week. It's a tough market. Yeah. And I sympathize with the founders. They don't know when to launch. All of these founders delay their launches. I think Barachain should have TGE'd early last year. I think Monad, I've heard they might not even TGE this year. It's tough. It's a tough market out there.
But Taran, to your point, just want to follow up one thing before we move on. Eigen, for instance, right? You and I both know when they were trading at 6-7 billion, people were looking at it like, hey, could we potentially buy this asset? At that point, Laura, we had like 20-30 million buyers sitting on the side. But the foundation chose not to allow these transactions happen. So what they could have done at that moment in time, just to give an example, go to your employees, go to your treasury, say like, hey, do we need a potential 20 million at this moment just to build up a bit more roadmap for us? If the answer at that moment in time was, yeah, sure. Or the second one, maybe if we don't need it, our investors might need that liquidity. So let us allow them to sell like 5-10% of their tokens, because at the end of the game, that's also their investment and they need an X amount of return. So that's what we try to advocate. Like, the pie is much bigger than only your piece. If you eat that, somebody else also needs to eat something at that point. And that's what I actually trying to mention.
I think the reason why they do that, like, founders, they hate it when their investors exit before them. I've noticed.
Sure, but Taran, you and I both know as well, their core vision is building a solid protocol for the community itself, right? And they built that through the money that they're getting from their investors down the line. And those investors, obviously, they have a time frame of, let's say, 5 years, 10 years. Some are much shorter, obviously, 2 years, 3 years, because it depends on the funds that you have. So if you help them out, and then once you go on to building Series A, B, C, D, whatever, then they will help you to connect with new founders who are on that level, because you have several types of investors, or you have 1 year, 2 year, 5 year, and 10 years. And then they will get you a different type of TradFi investors who will jump in and say, you know what, this is a solid investment for us, because they allowed their investor to sell their shares when they could sell it. So it's a positive thing at the end of the game. And that's what we mentioned, like, hey, it helps you as well down the line. Once you become a bit bigger, then you get better investments and better and bigger investors on that line. But yeah.
What I'd say, I guess for founders, founders is tough because they sort of just have to play the game as it exists. They can't really try and reform things. I think they have to profit maximize to some extent. They have a responsibility to their investors, to their team. But I think the main thing is to build real stuff, to not get carried away by the hype and the XRP, because I think the main thing people don't see is, like, you only, like, when you see XRP, for every XRP, there are tens of thousands of vaporware things that went to zero or never launched. And that is the median and the mean outcome for vaporware, is that it goes to zero, right? And the best way to try and build a real company is to build a real project that people use. Like, it's much easier to do it that way than to build vaporware and hope somehow you're the vaporware that goes to $300 billion. And so I think founders really get carried away with this. They see a meme going super high, and they see some project that they think shouldn't be worth what it is being worth a lot. And their incentive is to, okay, I don't know, when EigenLayer was big, and we're investors in EigenLayer, so no, not hating on EigenLayer, saying when they were big, everyone wanted to build restaking for X, right? It was like, oh, EigenLayer is worth $6 billion. I'll build restaking for Solana. That's going to be worth, some multiple of that, some fraction of that, and that's going to be a good exit. Or restaking for Y, and it's just such a waste of time and capital. And ultimately, it almost never works out, because as a founder, your timeline is like 4 years. You need to build the thing, launch the token. 1 year later, you start vesting. Like, the meta, and when you see all these restaking projects now, people have devoted 2 years of their lives to building these things, and a lot of them probably won't ever launch a token, right? It's just, it looked like a good decision at the time, but when you actually think it through, it's much less of a good decision. And so I think build something real that you believe in for the long term, and, like, also raise way less money. Like, people don't need to be raising $100 million to build crypto stuff. Like, this isn't hardware. It's not like deep tech. It's software. We have like AI now. It's very easy to build software, like small teams. So I think raising less money also solves a lot of the problems that founders end up facing in crypto. Investors advise sort of similar, like don't fund silly copycat stuff. And like, I mean, we're guilty of this too. It's not like we everyone makes mistakes in a mania. You know, you get carried away and you think you see free money or free arb, and you end up investing in things that sort of diverge from your thesis. I think not doing that would be super useful, because these big rounds also send signals to founders that this is what investors want to fund, and then founders do more of that stuff, and it's just like a circle. And then I think market makers and exchanges, I think exchanges specifically have the most power, because they're like the biggest retail like interface for crypto. And I think for them, really, as they've been doing, like they've gotten a lot better, but really enforcing standards and like publicly enforcing these standards around transparency of market making arrangements, around like your real float has to be disclosed and it has to like correspond to what's on CoinGecko, around like market maker arrangement, side deals, like all this kind of stuff, having like a real policy around it, I think would be really useful. Yeah, that's probably my recommendations.
All right. Well, this has been such a great conversation. Where can people learn more about each of you and your work?
SecondLane.io, or reach out on Twitter.
Yeah, I'm on Twitter at Taran_SS. You guys reach out anytime. DMs are open.
I'm on Twitter at Z-E Maria Macedo. I probably need to simplify that ticker. But yeah, you should be able to find me, and yeah, DMs are open.
Perfect. Well, it's been a pleasure having you all on Unchained.
Definitely. Thanks a lot. Thanks
very much.
Thanks so much for joining us today. To learn more about Omar, José, and Taran, check out the show notes for this episode. Unchained is produced by me, Laura Shin, with help from Matt Pilchard, Juan Aranovich, Pam Majumdar, and Marco Correa. Thanks for listening.